These are the biggest car manufacturers in the world, and Tesla is currently more expensive than all of them combined. In this video, we analyze Tesla and try to figure out if it is really worth the $1 trillion it currently sells for, or maybe even more. The company Tesla, with its famous boss Elon Musk, is currently one of the major drivers behind the electrification of the automotive industry. And you might ask the question how anybody can still be invested in producers of mainly gasoline-driven vehicles. But as investors, we're obviously motivated to find good investments, and the thumbnail is not an exaggeration or a joke. As of November 18, 2021, the day I'm making this video, for the price of the company Tesla at the stock exchanges, you could buy General Motors, Ford, Toyota, Volkswagen, Mercedes, BMW, Hyundai, Kia, Honda and Stellantis, which is the parent company of Chrysler, Fiat, Citroën and Peugeot. And of course, I don't mean the individual cars. I mean the whole companies, including all of the not mentioned sub-brands like Porsche, Audi, Jeep, etc. Plus, you would still have another 190 billion US dollar cash as walking around money. You may ask yourself, who in his right mind would pay that much? Well, the answer is everybody who currently buys stocks of Tesla. Even the opinions of the professional investors on Tesla vary massively. Cathie Wood, the legendary investor, founder of ARK Invest, and by my information heavily invested in Tesla, believes that Tesla could be worth even $3 trillion US in just 4 years. Michael Burry, the legendary hedge fund manager who predicted the real estate bubble in 2007 and made a fortune by shorting it, is now shorting Tesla and believes they are massively overpriced and suggested the stock price could fall by 90%. Let's try to leave emotion aside and have a rational look at this. Because the truth is, only because you have to pay a lot of money for a company, it doesn't automatically mean that the stock is expensive. And looking at some of the other companies, of course also the opposite is true. To find out if Tesla's price is cheap, moderate or expensive, we have to find out what we actually receive for the price. This is the value of a company. Imagine you buy a burger for 50 cents. You know that this is a very cheap price for the value of the hamburger. And paying $100 is definitely way too expensive for the value of the burger. The value of a company is something that we do not really have a feeling for, like with a burger. But there are ways to get this feeling. The definition of the value of a company is pretty simple. It is all the cash that we as owners or shareholders of the company will be able to take out of the company in its remaining lifetime. And to have this as a figure we can work with and can compare against other investments, we discount it to today. The first part of the value calculation is the liquidation value. This is the easier part. It tells you what the owners would receive if all the assets of Tesla are sold and then all the other creditors would get their money back. When you followed the development of Tesla in the past years, you know that they expanded a lot. They sold further stocks and increased their capital. They built or are currently building several factories all over the world, like in California, New York, Texas, Berlin, and Shanghai. They invest a lot of money in their battery energy storage business and their solar energy systems and acquired several smaller companies. So there should be a lot of capital available and maybe some value in this. But how much? Let's look at the balance sheet from the latest annual report. This is Tesla's balance sheet from the 2020 annual report. The cash equivalents and the accounts receivable are taken as they are. I often reduce the value of the inventories a bit if I see a risk that they could not be sold later or only with price discounts. In this case, I don't think that it is necessary. The automakers currently more have the problem of actually getting enough components. Therefore, I also take the inventories as they are and the prepaid expenses and the other current assets as well. The part that is a bit more difficult are the long-term assets. Everything that I do not fully understand will be taken out of my calculation or at least adjusted. The operating lease vehicles are something that could probably be sold in the open markets in case Tesla would have to. Not sure if you could sell them at the price in the books. Let's be a bit careful and consider them with 80% of the value. The entry solar energy systems is Tesla's second field of business. I did not make an analysis of it and can't tell if it is worth the price that is shown here. I will consider it for my calculation with 50% of the value. Property, plant and equipment is all the capex, the factories and toolings. They are pretty new as Tesla just built their factories a few years ago or is currently still building them. And equipment to produce electronic vehicles is probably something that you could still sell in today's market development in case of a liquidation. So I assume this with 75% of the value. The other long-term assets are something that I don't understand well enough to put them in the calculation, especially the goodwill and the intangibles. But compared to the rest, it is anyway not a relevant figure. Therefore, I'll just ignore them. To receive our liquidation value, we now have to deduct all of the liabilities. They are something that has to be paid back. That's why we will not adjust them. When we add everything up and deduct the liabilities, we receive a total liquidation value / shareholders' equity of $13.3 billion. So, the capital situation of Tesla seems to be in good order as of today. Although it definitely doesn't account for a major part of Tesla's value. But we know that the value consists of two parts. And the second part is all the cash that Tesla will generate in the future, discounted to today. Before we look at the figures, we need to get a better understanding for the growth potential of Tesla. For this, we remember what the famous investor Philip Fisher demanded for a great business. Does the company have products or services with sufficient market potential to make possible a sizable increase in sales for at least several years? Tesla's sales growth in the past decade was nothing but spectacular. They grew their vehicle volumes from 22,013 to 500,000 in 2020 and their revenue from $2 billion in 2013 to $27 billion in 2020. The growth rate continues to be amazingly high. But what are their growth plans for the future? Is there enough potential to continue growing? Tesla updated its factories in Shanghai and California, and they are about to start production in their new facilities in Berlin and Texas. This increases their production capacity by my calculation to circa 2 million vehicles annually. They announced the Tesla Cybertruck, where they claim to have already received more than 600,000 pre-orders. Production start is planned for 2022. Then they announced the development of the Tesla Semi, a battery-powered Class 8 semi-truck, with a production start currently planned for 2023. Tesla also discusses to enter the smaller vehicle segments below the Model 3 with a car that is supposed to be placed and priced in the $25,000 segment. Furthermore, they announced the start of an autonomous taxi service. Let's look at the figures of the second part of the company value. For this, I use my company analysis spreadsheet. This is the development of the free cash flow in the past 10 years since 2010. You see that Tesla burned through a lot of cash, but since 2018 they generate positive free cash flows. What's interesting is that the earnings still show negative figures until 2019, so the free cash flow indicated the positive development already a bit earlier. The problem for the projection of the future free cash flow is that the figures are anything but stable and most of the years negative. So it is more than difficult to derive an accurate forecast from that. To generate our prediction, we need to look at another growth measure, the growth of the revenues and the sold vehicles. This is something that I usually only do as a backup and to double check if my calculated figures are correct. But Tesla is a bit different, so we have to be creative. As you can see in the chart, Tesla's revenue grows strongly in the past years. The 2021 figure is an estimation by myself, based on Tesla's 9-month results. Also, the sold vehicles grew in lockstep. The spike in the growth rate of 2017-2018 is the launch of Model 3 that took Tesla's market position to a whole new level. The growth seems to slow down in the past 3 years, but keep in mind that businesses don't grow as steadily as Wall Street wants them to, and we have to also remember that it is becoming more difficult to grow the bigger the business is. Let's use the average growth rate of the past 3 years as the starting point for our free cash flow prediction. That is 36% for the sold vehicles. We take the figure and put it into the value calculation tab. With the growth of the company, we assume that the growth rate of the free cash flow will slow down over the next 10 years by 10% per year. Afterwards, it will remain on the level of year 10 for further 5 years. I usually do not put in anything beyond 15 years from now, because the discounting of the cash flows will make them less relevant for every additional year, and their contribution is becoming lower. I consider this to be covered with a steady growth rate from year 10 to year 15. Now we put in the free cash flow from the last full year that we have. That is the already known $2.8 billion. As discount rate, I usually use 9 or 10%. Why I do that and why you could also use a different discount rate when you do your value calculation, I show you in the short video on discounting that I set a link to in the corner. With these figures, the sheet immediately calculates the future free cash flows and discounts them. The total present value of the future free cash flows is added up to $112 billion. We already know the liquidation value, also known as shareholders' equity. That was the first part we calculated. We add this to the future free cash and receive a total present value of about $125 billion. This is the fair value of Tesla, assuming the above growth rates are about right. But how much is this per stock? For this, we take the total present value of Tesla and divide it by the total number of stocks outstanding, that is 1.13 billion shares. We receive a value per stock of $111. As of today, Tesla costs nearly $1,100 per share at the stock exchanges. That is 10 times more than what we consider as the fair value. It's actually not that long ago when Tesla shares were traded for that price. The last time was beginning of April 2020. That's a bit more than 1.5 years ago. To justify today's market price, Tesla would have to grow by 50% per year for the next 15 years. If Tesla's price would crash down back to this level, should you buy Tesla for $111 per stock? $111 is the price that you should pay if you're satisfied with the 8% annual return that are included in the discount rate, and if you're 100% sure that Tesla will achieve the assumed growth rates in the next 15 years. But there are several risks that could hinder Tesla from growing that fast and that require us to apply a margin of safety. Personally, I believe that of these risks, there are at least 3 that are not really considered by the markets yet, although they are pretty obvious. Number 1, the competition. All the other big auto producers are currently launching or at least developing electric vehicles. Many of them already announced to shift their production to electric drives in the next 5 to 10 years or did already start the change. This is going to increase the pressure on Tesla's prices and margins heavily. Tesla will not be the only one to produce electric vehicles in mass production anymore. Of course, they work on improving their margins and they definitely already have certain competitive advantages, like for example the technology and the mass production benefits for batteries. But the competitive forces will be insane. Number 2, low-hanging fruits. A good portion of the low-hanging fruits has already been harvested, like the group of the so-called early adopters in the higher-priced car segments. To continue to grow with similar rates, Tesla will have to enter high-volume segments where the customers are usually more price-sensitive. This is going to put even more pressure on the margins. Number 3, Elon Musk. Tesla is heavily depending on one person. He was the key driver for the incredible development of the past decade. What would happen if he would suddenly not be available anymore? And I do not only mean the risk of death, however small or big this may be in times of Corona. What if he chooses to follow up other ventures, like his space activities or something entirely different? Would Tesla be able to grow in a similar way or even survive without him? Of course, I don't believe that it is very likely that he's not there anymore for Tesla. But when a company is that dependent on one person, it is something that the other owners should consider for the valuation of the company. By the way, not only I see the risks 1 and 3 as critical. Tesla itself included them in their latest quarterly report. Quote, "We are highly dependent on the services of Elon Musk, Techno-King of Tesla and our Chief Executive Officer." Elon Musk himself tweeted on May 1st, 2020, "Tesla's stock price is too high in my opinion," and confirmed in an email exchange with the Wallstreet journal later that day that he was not joking. This is about 1.5 years ago. Tesla's price that day? Around $150 per share. Of course, it is solely your decision if you invest in Tesla or not, and at this point I'd like to make you aware of the disclaimer again. I'm not a financial advisor. You have to decide how big the risks are and which margin of safety you like to apply. Considering the risks and the optimistic growth rates, I would demand a margin of safety of no less than 50%, which means that I wouldn't pay more than $50 per stock. The founding father of value investment, Benjamin Graham, once said, "A great company is not a great investment if you pay too much for the stock." For me, Tesla is certainly doing an amazing job, and Elon is always good for the one or the other surprise. But the price of its stock is way too high for the inherent risks. If you want to be successful with investing in stocks, it is important that you avoid to make the big mistakes. The smaller ones can be frustrating but extremely instructive. In this video here, I show you the 3 mistakes I made with the company Starbucks and how they improved the way I'm handling my investments today. See you in the next one.